Continuing with objective 4 in this chapter, placement securities and the blocked securities. Actually, the main difference between placement securities and the blocked securities is that one type is purchased for the aim of trading for the short term, which are placement securities, and the other are purchased for more long term for investment, non-trading aim. So the both of these securities, placement and blocked securities, are evaluated upon acquisition at their purchase price. It means that they are evaluated at purchase, not at cost. So all charges related to the additional purchase price are not added or recorded to the value of these securities. They are recorded as additional purchase charges. They are recorded in account 62692 financial services or financial charges. But upon inventory, the general accounting procedure distinguish between two cases. If these securities were priced in the stock market, they are evaluated according to their average price of the last month of financial period. It means the company related to these securities is listed in the Beirut Exchange stock market. However, if these deeds are not priced in stock market, then they are evaluated based on expected sale price. Let's see a practical example. How to register the provisions in the books of an enterprise who have a blocked securities and the placement securities at the same time. We have this example. The portfolio bills of MK Enterprise includes the following: 1000 shares issued by ABC Enterprise, purchased by $1,500 per share and registered upon purchasing in account other blocked securities. Also, we have 200 shares issued by DAF Enterprise, purchased by $700 per share and registered upon purchasing in account placement securities. It was revealed upon inventory that the market price of ABC Enterprises shares is $1,420 per share and the market price of DAF Enterprises shares is $640 per share. If you know that these shares are both not priced in stock market, it means that they are evaluated based on their expected sale price in the market. We have to record the necessary provision entries. So I have to calculate the provision needed for each type of securities. For Enterprise ABC, I have 10,000 shares. I have the difference between the purchase price and the inventory value, which is 1,500 minus $1,420 per share, equal as a total of $800,000 as a provision needed. For DAF shares, I have 200 shares. The decrease equals $700 minus 640. I got $2,000 in total as a provision. So for ABC shares and DAF shares, I have a total provision to record for a total of $812,000 in value as provisions. So in the entry, I have to debit 679 account amortization and the provisions on financial charges, $812,000. I have to credit 2953 account provision for diminution in value of other blocked securities, and credit 59 account for provision for diminution in value of placement securities. So the only difference is the type of account I use for blocked securities and placement securities. I use 2953 for recording provision for blocked securities and 59 for provision for recording for placement securities. Every type actually or a group of securities should be revised alone. So this is a very important note. I can't mix actually the two types together because we said One type is purchased for long term and the other for short term for trading and other for non-trading. So every type should be revised alone, and a balancing between the different kinds of securities is not allowed. So this is a very important note to pay attention for. Let's see another example for portfolio bills acquired from different companies, from different enterprises. The portfolio bills of Gamma Enterprise includes the following: 500 shares issued by Alpha Enterprise purchased by $5,500 per share. We have 700 shares issued by Beta Enterprise purchased by $3,750 per share. The following information were revealed upon inventory on 31/12/2023. Market price of Alpha Enterprise is $5,100 per share, and the market price of Beta Enterprise is $4,000 per share. Knowing these securities are purchased for the purpose of competition and market, I have to prepare the necessary provision entries. So this information given is very important. I have to pay attention. When he tell me that these were purchased for competition and market, it means that these are placement securities. Okay, mean these are placement securities. I have to calculate the necessary provisions. I start by alpha. I have 500 shares. The decrease is 500 minus 100 equal $200,000 as a total. Beta market price is greater than purchase price. I have no diminution, no decrease for the shares of beta. Only I have decrease for the shares of alpha. So I have to record a total provision of $200,000. The entry is I debit 679 amortization and provision on financial charges, and I credit provision for diminution in value of placement securities in account 59. So here I have alpha and beta of the same type. They are both placement securities. So it is allowed, but on total responsibility of the director of the company, to not take a provision for a decreasing security if the decrease is exceptional. This is also a note according to the Lebanese chart of accounts to have to pay attention for. Let's move to different type of example. Here the portfolio bills are acquired from the same issuer enterprise. I have portfolio bills of Zeta Enterprise, which includes the following: 700 shares issued by MSN, purchased on 7/1/2023 at $800 per share, 650 shares issued by MSN Enterprise. So here, as you can see, we have same company which issued at two levels. First time 700 shares and the second 650 shares. So here the second one 650 were issued at $1,000 per share on 1/4/2024. On 31/12/2024, the market price was $8.50 per share. If you know that these shares are purchased for the purpose of competition and market, it means these are placement securities. I have to prepare the necessary journal entries for provisions. So the provision needed for Zeta Enterprise, I have the market value, which equals 700 shares for the first one bought plus 650 shares from same enterprise times 850. I have a total of market value $1,147,000. Comparing with the book value, 700 shares bought at $800 plus 650 bought at 1,000. I have a total cost as book value $1,210,000. So the difference between the book value and market value is a decrease of $62,500. So I have to record the provision by this diminution in value. The entry would be I debit 679 account amortization and provision on financial charges 62500. I credit 59 account provision for diminution in value of placement securities. Moving to the second part of this objective regarding how to manage the provision and the books of the company related to placement and blocked securities. At the end of each year, the accounting department should revise the portfolio securities either for, as we usually do, for assets or inventory, whatever. We either take provision or increase or decrease provision or delete the recorded provision. If the market price of securities is greater than the purchase price, so no entry needed. If the market price is less than the purchase price, so an entry is needed to record the provision. If the company take provision and upon revision of the price found it has higher than the year before, so the company should revise or write back or refund uh, part of the provision recorded. Here is a real practical example. The following schedule shows the situation of placement securities involved in enterprise at the end of two consecutive financial periods. We have securities A, B, and C. We have 2,000 securities of type A, 3,000 of B, and 5,000 of C. Let's say they are from different companies but of the same type. So the purchase price for each one, we have $1,500 for A, $2,000 for B, and $1,000 for C. Market price per share, per one share on 31/12/2022, given as 1,375, 1,850, and 1,200. Market price on 31/12/2023, 1,300, 1,920, and 9,900. We have to prepare the necessary provision entries on 31/12/2022 and also the provision entries on the following year 2023. Start counting the provision needed for these securities. For Enterprise Air shares, we have 2,000 shares times the difference between market value and book value, 1,500 minus 1,375, we got $250,000 in total. For Enterprise B, 3,000 shares times 2,000 minus 1,850, we got 450,000. And for C, we have no decrease, no diminution in value. So we have a total provision to be recorded at the year of ending 2022, $700,000. So the accounting entry would be I debit 679 account amortization and the provision of financial charges, and I credit 59 account provision for diminution in value of placement securities by the total amount $700,000. Now I move to the following year, which is 2023. As you can see, so I have to manage year 2023. The provision needed is also for A would be $400,000, difference between market value and the purchase price. For B, decrease also would be $240,000. For C, I have a decrease for an amount of $50,000. I have a total provision of 400 plus 240 plus 50. I have to compare with previous year 2022. I have to compare with previous year 2022. For A, I recorded 250, for B, 450, and for C, 0. So the provision needed in 2023, I have to increase those for A provision by $150,000. For B, I have to decrease it by $210,000, and for C I have to increase it by $50,000. So therefore the total provision is to increase by $200,000 for shares A and C, and for B is to actually to decrease it by $210,000. So I have two types of entries to record. The first entry is to increase the provision by $200,000. I debit 679 amortization and provision on financial charges, and I credit 59 account provision for diminution in value of placement securities by $200,000. The entry to record the decrease in provision for securities B is to debit provision for diminution in value of placement securities account 59, and I credit 779 account financial provision write back by $210,000.